Hi, everybody. Good morning. I'm glad I'm on time because I was in Europe and my computer was telling me that daylight saving was this weekend. So I'm quite happy to be here as part of the Texas Bitcoin Conference. The slides are available online at slideshare.net/LaBlaga. And I am happy to be speaking with you about blockchain economics, payment channels today. How many people are familiar with payment channels? Excellent, so about half people so far. As Linda mentioned, I have a Wall Street background and MBA, and I'm currently a technology theorist in the philosophy department at Purdue. I wrote a best-selling book, the O'Reilly book, Blockchain, to encourage us to build this vision of the world. And this morning, I'd like us to get our mindset of innovation on. Someone is going to create the Netscape or Google of blockchain, a killer app which makes this technology mainstream and useful, and we should keep our eyes on that. So I'll be talking about payment channels. And to do so, I want to recall network architecture to our mind. So we're familiar with centralized networks and even decentralized networks that have a hub and spoke architecture. But the thing we're talking about with distributed ledger is distributed networks, where every peer is a node in the network. And the radical implication is that any peer can provide services to all other peer nodes on the network. This is actually how the Bitcoin blockchain already operates, that nodes provide services to other nodes. So the transaction ledger is hosted by about 10,000 peer nodes. The mining operation provides settlement confirmation and logging for all of the peer nodes. And we're starting to see news services, a decentralized Reddit concept like Steemit or Yours. And the implication is that we can, with payment channels, have peer-based banking services. And so payment channels, the concept, there are really two parts of the key concept. So the first idea is that a network is a computing graph. It's a very familiar concept in computer science that the graph is a set of nodes and transactions can arbitrarily flow across the entire network. There are, we could consider a network as a payment graph, a credit graph, or a transaction graph. Now, the second key point is this point about net clearing. So if I owe you $10 and you owe me $8, instead of each paying each other the gross level, we can just settle the transaction on a net basis with a $2 payment. And so that's the crux of the payment channel concept, is this net settlement or net clearing concept. Sort of like contract for difference without the 10x leverage or spread betting, but the key concept is a net clearing. So specifically, a payment channel is a three-step financial contract executed over time. First of all, one party opens a payment channel with another party and posts a prepayment escrow on file. Then the party consumes services against this credit payment over time during the period until finally at the end of the period, cumulative activity is booked in one net transaction to close the contract. The motivation for the payment contract is to not have to book every small coffee that you consume to the entire Bitcoin blockchain, but rather to just post net activity. Initially, the idea was for consuming YouTube video, for example, we don't need to pay for every microsecond consumed, but we can have a structure like a payment contract to pay for aggregate use. So right now in the Lightning Network concept, which will become valid with SegWit 2, the blockchain hard fork implementation coming in November, there is a limit on the maximum amount of the payment channel of $175, essentially 4% of a Bitcoin value. But this is arbitrary and could be set differently in other kinds of payment channels. The bigger implication is that payment channels might develop into a digitized payment system for resource consumption that settles based on net payments instead of gross transfers and enables peer-to-peer banking services. And there is additional sophisticated functionality that I didn't mention, such as time and signature locking and concatenated payment structures. So let's look at 5 levels of examples. Payment channels level 1, the Starbucks example. So in this case, you might open a $50 monthly payment channel with Starbucks and then consume daily coffee against that contract, which at the end, activity is netted, and contracts could be closing, regular contracts could close on a periodic basis and roll over. A key feature of payment channels is that either party can elect to close the channel at any time, triggering the net settlement transaction. So I submit to you that Starbucks is already running a prototype payment channel through their loyalty program. 41% of Starbucks coffee purchases are via their cards and apps, and that for them creates on the balance sheet a $1.2 billion cash availability, as well as a liability for the offsetting stored value cards. So immediately, this already raises questions about the legal and accounting treatment for this new kind of idea, a payment contract. It's the promise of cryptocurrencies as programmable money, but how do we classify this new kind of entity? A contingent 3-part financial contract over time is really a new kind of instrument. We notice that it has other features of financial contracts, such as prepayment risk, since either party can end the channel at any time. There is European and American style option contractual settlement functionality, as well as a fractional reserves question about the credit payment posted on file. So from an accounting perspective, is a payment channel a deferred payment, an installment sale? When do we recognize revenue and liability? Similarly, from a legal perspective, is a payment channel an assignment of claims, or maybe a forward-looking IOU? So payment channels level 2. This is a small group concatenated payment channel. So we have a scenario, this was initially proposed by Andreas Antonopoulos, where we have Lynn, Chris at their local bar with the bartender. So the standard format would be that Lynn has a $10 tab with the bartender and has consumed $6. Chris has a $10 tab with the bartender and has consumed $5. And then Lynn and Chris play pool, and Chris ends up owing Lynn $5. So I have spelled out, if you would like to review later, the detailed ledgers of these transactions. But the current method would be a gross settlement, where each party settles with each other, which would be 3 transactions for a total of $16. But the new method, in a net payment channel, would be only 2 transactions, closing out the $10 to the bartender from Chris and the additional $1 from Lynn. And so that would only be 2 transactions and a net amount transferred of $11. So already the implication is that less money is transferred, which means more money is available for other kinds of activities. Now considering payment channels level 3. This is my monthly expenses example. So I argue that maybe we are already running a less formal version of a payment channel in a lot of ways. So considering monthly expenses, many people have direct deposit paychecks coming in and then auto pay of their key expenses, a car payment, rent, utilities coming right out of the same bank account. So this could be formalized into the structure of a payment channel, maybe that any remaining net amount going out to an investment account. So again, the implication is that settling on a net basis frees capital, and we could consider many kinds of business entities on this net basis. So I think of my monthly expenses that can roll up to my apartment building, which also has expected inflows and fixed and variable outflows and a net amount at the end. Similarly, my small business. And this could roll up even farther to my supply chain, a payment graph economy much more broadly. So conceptually, this causes us to notice that so far blockchains are really only about the cash account. If we consider the landscape of general ledger accounting, only the cash account has been handled so far. So Bitcoin is essentially a ledger and subledgers of who owns what positions in cash. But if we wanted to do something more robust, we would start to think of property registries. So for example, Mike Arrington has recently purchased apparently the first blockchain-based piece of property within Ethereum blockchain and a company called Proppy. So this is like Meg Whitman buying the first eBay Motors car in the early 2000s, a proof of concept transaction on a blockchain. And so in this case, property registries would need to start using UTXOs in the same way that we do for cash, but for assets. And similarly, a birth and death registry chain would have one debit and one credit. If we started to think about applying general ledger accounts on a much broader basis to the supply chain, what would be required for supply chain finance on a net basis is truly integrated books, not just by entity, but across the entire supply chain. So the revenue, maybe the revenue is to Walmart, but the COGS are to its suppliers, John Deere and Adidas. And so we also start to notice that in the supply chain, the goods manufacturing trajectory is different from the payments trajectory. So now considering payment channels level 4. In this case, we have what's called the Kevin Bacon problem, which is if I want to send money to Spain or some other country, I may not know enough parties in between. But with a network, I don't need to. As long as I'm a network node, the network intelligence can find other parties to hop or transfer the transaction through. So the result is that we have a very large network payment graph where maybe either every node is a peer banker, or in the Lightning Network case, there might be hubs and payment gateways. So now considering payment channels level 5, this is what I call the Mike Hearn example, because he suggested the idea that smart resources would just sense demand and automatically instantiate in blockchain systems. So similarly here, what you notice from a peer node network is you don't actually need a human behind the node from a technical perspective. The network can serve as a banking system on its own. And so far we've vested legal roles and responsibility and taxation in individual personhood and corporate personhood. And so we might revise that in the future for network personhood. So some of the implications of payment channels are that with money and payments digitized and activity being securely forward committed by payment contracts, the implication is that net flows instead of gross flows might be transferred. An economy based on net clearings rather than gross transfers could mean more activity and less debt. So this could allow us to rethink how we do debt, with a streaming money concept that's disgorged in much smaller chunks that are more closely tied to costs and repayment possibilities. The challenge we might think about is how to construct net rather than gross obligations for home mortgages, student loans, public works projects, and bond offerings. Similarly, we might think the modes of consumption that we do in the economy, prepay versus postpay. There's not a lot of activity that is prepaid. The much larger portion of economic activity is based on credit and terms, with 2/3 of the economy being tied up in supply chain finance. That's because the incentive is to play the float. But instead, we might use this payment channel concept to rethink supply chain finance. So we think because the Lightning Network is just starting to come into effect now, that payment graphs are a new idea. But really, the Ripple credit network has already been an example of a payment graph for the last 5 years. This network has, it's an open credit network. It has approximately 100,000 wallets, 250,000 credit links, and has conducted 27 million transactions. The transaction types are highly interoperable. They are, you have the ability to transfer fiat currency across borders, exchange cryptocurrencies, and have user-defined currencies. In addition, not only can you transfer cash, but you can issue credit. And here's a more specific example of how the Ripple credit graph would work. So payment graphs is really just a continuation of the algorithmic trading we already see in high-frequency trading, real-time bidding markets for advertising, and global energy trading. So we would just expect that we'll start to have algorithmic banking. Concluding, we want to think, how can we use these tools and concepts for a larger class of economic problems? How can we use notice that the economic incentive is counter to the outcome in many cases, such as healthcare services, where there's a lack of price rationalization. In the supply chain, the incentive is to play the float. How could payment channels help us address entitlements or income inequality or the automation economy? Further, right now we have to own investment assets, stocks, bonds, mutual funds, but how could we adapt these to the Uber economy as well, where what we're wanting is access to the consumable benefits without having to own the underlying? So a few resources. These are some recent publications in both blockchain philosophy and blockchain economics. I have an open book project if anybody would consider contributing a 4,000-word chapter by March. Which is not a big deal, I invite you. And this is a list of different standards bodies working on digital ledger initiatives that you might elect to join. And again, the slides are available at slideshare.net. Thank you.
Thank you, Melanie. Now we'll take some questions. Who has questions? You explained everything so well.
Ma'am, as I understand, what we are doing is we'll be sharing information from all the ledgers of all the individuals along the line. Wouldn't this be kind of a sharing your guts to everybody?
So the privacy
Yes.
concern.
Yes.
So many people who have been analyzing so far, both Bitcoin as well as the Ripple network, have pointed out that even using pseudonymous wallets and all kinds of techniques for anonymizing your transactions, in fact, it is quite clear the transactions of Santander Bank, for example. And so network hygiene, yes, so the issue is maybe the difference between public and private ledgers. And so some of the banking ledgers, for example, Ripple is open, Bitcoin and Ethereum are open, but many of the industry consortiums are closed. And so the reason that they aren't progressing as fast as they could be is because even within a closed group, not everybody or people are still concerned about privacy. So I think that you have to be willing to expose some amount and that we're improving on our anonymization techniques. And this is a key issue going forward in the area.
Questions?
You said that Lightning was dependent on the an upcoming hard fork?
Yeah, SegWit 2. So SegWit 2X allows, would you jumping in before you finished your question?
That's okay. I thought it was only dependent on SegWit, but not the 2 megabyte block size change.
It's not directly related to that, but that starts to make it possible to run a SegWit wallet. So the reason we haven't seen, people were just starting to get going with the Lightning Network payment channel activity. People, you can download the software, install a Lightning wallet, try to get a payment network going on the test net. And the reason we haven't seen more of that yet is because SegWit 2X really makes that possible. So we would expect to start to see a lot more of that kind of activity in November, December, and next year.
Could you go into detail as to why the 2 megabyte block size makes that more possible than simply having a 1 megabyte chain with SegWit enabled?
Yes, or I mean a little bit. This is not really technical talk about that, and there are many detailed resources about that on the web. So the hard fork does about 4 or 5 good technical things, like reduce transaction malleability, improve scalability, and it's also allowing these other kinds of SegWit 2 wallets to be enabled. So you need to move all your funds over into a SegWit compatible wallet to access the new functionality from the fork. And so it has to do with, or the main concept in SegWit 2 is that it's improving scalability by moving the signatures portion of the blockchain, which comprises about a third of the size, off into a segregated witness chain, a separate chain that's still associated to it. So that's the main idea. That's how it's improving scalability from block sizes of 1 megabit to 2 megabits.
This might be a simple question that's got a really long answer, but I think it's really cool that we can start looking at net payments.
Yeah.
I'm a little uncomfortable, maybe it's because I haven't started thinking about it before. Is that a good thing? It feels to me like there's a lot of, if you net out all the stuff I had all the way through my life, half the time I was insolvent. And so I'm just, I like the idea, it's pretty cool we have the technology. I'm just not sure with things like my need to hold a little cash in case something goes wrong or other things that I want it.
Yeah, thank you. I think that's the key point is what does a net payment economy mean? And do we want it? Do we not want it? Maybe in some areas it's easier. So what are the arguments for and against it? And so for sure, we like the security of cash in our hard cash in our fist, but and what does net really mean? Because then you notice it's just turtles all the way down. So if I have my monthly expenses net, but then I consider my apartment building on a net basis, and then the local city economy on a net basis, and the national economy. So where does it stop, or what would we have to move the whole system to net instead of gross? We have some examples, and still central banks clear amongst themselves on a gross basis, and so it's really close interbanking partners that move to this net basis, where it really makes sense in a game theoretic situation to clear on a net basis because we're transferring 2 ways so much. So I think it could be just like networks. Like we used to only have centralized networks. Now we have centralized, decentralized, hybrid, distributed. So we have more kinds of flavors. And so similarly, when does it make sense to do a net contract basis versus gross? And is it overly complicated and introducing more risk if we went to a net basis? Do we now lose? There are so many interdependencies that essentially the whole economy trades like a high frequency hedge fund, which we wouldn't want. So I think it's an intriguing notion. It's a new functionality, and it will be interesting to see how we think about it and use it.
I had a question about, as you look at this whole process, have you looked at what the effect could be on interest rates? I mean, we're in a low environment right now, which kind of facilitates that.
Yeah, and a lot of the book, The Curse of Cash, for example, points out some of the benefits and probably long-term expectation that we'll be it's not like we bounce to low interest rates. It's probably a persistent condition for decades. So it's something to plan for the future. Yeah, that's an interesting point. So does it make more sense to do net basis in certain kinds of interest rate environments than others? I didn't think in detail about, I thought more about money supply issues than interest rates. And interest rates seem to be less of a denominating factor in decision making in business now, simply because it is so low.
Yeah, in your lifetime, yeah.
Oh yeah, no, I appreciate that. Yeah. Yeah, or you think of many other countries at the moment that have persistent high interest rate economies.
Other questions?
So this isn't directly related to your presentation, which was fantastic. Thank you. But a question as far as with your work in academia at Purdue. I live right across the street from the University of Texas, and this past August, when school started back up again, I went back to McCombs, the business school I attended a few years back, and I was just trying to find anybody that was involved in the space, and I went through, the MIS floor and the finance floor, and I said, is anybody interested in Bitcoin, blockchain, distributed ledger technology, fintech, just all the buzzwords. Nobody's interested. Nobody owns Bitcoin. Nobody's looking into this. We're not teaching. We have a fintech class that very briefly, there's like one chapter on blockchain, and this entire revolution seems to be completely missed by academia. And I was just wondering if you could comment on maybe why that is, if you're seeing that at Purdue, and if and when you expect that to change.
So I hear you saying opportunity to start something, and I had thought there was a Texas Bitcoin club if it, with the university. So it's academia lags the real world. And furthermore, blockchain is complicated to learn about. So a lot of people, you need to invest some time to learn about it and figure out how it works with your topic area. So yes, for sure, the business school is an obvious entree. There are starting to be more blockchain economics institutes, and I collaborate with, all sort of most of them worldwide, and they are my team for the book project, the current book project. I'm proposing and hoping to teach a blockchain economics class next year, and so that'll be at Purdue. It'll be cross-listed between the liberal arts school and the business school, and so I will need to. I'm concerned about it being innovative and being not getting approval for that reason. But I think it's very important that we try to push for academic development of blockchain kinds of topics. And it's definitely in the computer science department because it deals with distributed networks and network communications and cryptography, but it's not as much in other disciplines. But it's very much an interdisciplinary kind of topic because it's accounting ledgers on distributed computing networks. So this requires a new kind of study about it academically, I think.
A long, long time ago, you only got a mathematics degree if you were in computer science. Now they offer computer science, so it's coming. Anybody else have questions?
I've been trying to understand Lightning and its implications. I kind of understand it from a technical basis. I certainly don't have any larger understanding of the economy. But from just a single person's use case, couldn't opening up a channel with a Lightning hub be very similar to just opening up a checking account and not really any different from that as far as my own economy, and only closing out the checking account would be like netting out. I mean, I might not do that for, a decade. Am I missing something out of that?
No. So on the one hand, all of these blockchain ledgers should be unobtrusive applications to mainstream. It's just an easier way. Your bank introduces it. You trust it. It's like an ATM, a new version of an ATM. So it just becomes quite normal and natural. You don't have to. The layperson shouldn't have to understand how a Lightning node operates. So what's different though is these payment channels. It's a more regular netting. I don't have to close the account to net it. I don't have to close my Starbucks loyalty program to net it. Somehow now the network intelligence nets accounts on a more regular basis. So that improves the accounting and the liquidity for all parties. So that's one element that's different, but otherwise it's very much the concept of running a tab with anybody, having an account with anybody. So we're trusted parties, we have reputations, we're contractually obligated on the network, there are checks and balances, and so it's just more efficient to run a tab in many kinds of places with periodic netting.
Questions?
So you've obviously thought a lot about this. I guess a question just comes up. Settlement. So right now in our economy, settlement happens through systems that just kind of were born out of history and constraint and so on and so forth. What are the sort of, in this new world, what are the factors for settlement? Like how do you think about that?
Yeah, so it's programmable money, so you can set up whatever you want. So for example, we can have the related concept might be long tail economic services. So we already know from Amazon and eBay that in fact, 37% of economic activity is long tail in the sense of individual buyers and sellers can find each other for specific purposes. So I think in economics too, we've only had one size fits all. There's a 30-year fixed mortgage. But well, actually 22 years suits me better because that's when I plan to downsize my household. And so we'll start to have more choices, more granularity about economics and financial contracts that suit our needs. On the government side, we can measure, too, which public services that I'm paying for that I actually consume. So right now, these are both big slush pools because we haven't had more granular accounting methods. But now, unobtrusively, we can find out who uses which services, and that can be much more efficient. So the settlement basis will be, we can specify whatever different kinds of contracts we would like. And so that's the key point, and that we'd probably have different kinds of standard new programs. So a payment channel, so monthly settlement is sort of a time frame that feels comfortable and familiar and appropriate. So we'll have different kinds of standard mechanisms. It's not going to be completely greenfield, though, but there's an opportunity to develop new kinds of clusters and families of products that tend to suit our needs better. And I got a 5-minute signal, I think. 10-minute until networking.
Thank you. Do you have any concerns over loss of decentralization with Lightning networks where you have to run a Lightning network alongside the node? The same thing on the Ethereum equivalent where you have to run a Raiden or a Plasma channel alongside. We're already in a situation where a majority of the hash rate on both chains belongs to major mining pools. And we saw with SegWit, it takes a while for all the nodes to upgrade, right? So.
Yeah, so technical, whatever some of the technical challenges, and furthermore, what about consensus? Is that our current consensus methods, proof of work, proof of stake, really long-term methods because they're consuming so much energy, and the mining power is concentrated 70% in China and dictating the chip development R&D cycle because you really have to have a large dedicated facility. So the one point about consensus is that the current methods may evolve over time, and we might have to have something that's much more efficient than proof of work, which is very secure, but it's not scalable. And so I really like the class of thinking coming out of Dfinity and String Labs, Dominic Williams in Palo Alto. So it's an idea for a world computer still based on random number generation and entropy, but in a more efficient way than our current proof of work, proof of stake methods. And so therefore, you would want a scenario where it's profitable again for individual nodes to provide pure network computing resource. And that would be one goal. And then the other point, or I thought you might have been going after another kind of point as well, but that's the main point, is that we expect shift in the consensus algorithm over time.
Questions?
Hi. It seems like this would be really disruptive to all the credit card companies because they're charging like 3% fees, or all the credit card processors, the middleman between that. And how do you think they would fight back in regards to this?
Well, not only is our current solutions expensive, but they're not secure. So half of us are hacked with Equifax, and so we just have continuing proof that the cryptographic security of centralized solutions don't work, and we need decentralized solutions. So if you're a credit card company, you're like the New York Times 10 or 20 years ago with internet publishing and blogs, and so you reinvent your business using the new technology alongside everybody else. And so so there is talk of The SWIFT network has been saying they're trying to move to a blockchain solution, but it's technically regarded as mainly a marketing kind of announcement. But really, if you're in this kind of business, you would use the new technology to reinvent what you're doing. And so what better comeback for Equifax, et cetera, to offer decentralized solutions that protect the privacy and anonymity of customer data and don't have a big centralized database that hackers want to attack. And so not only is it going to be a lot cheaper with cryptographic solutions, but also handles what we really care about also, which is the cryptographic security.
Questions?
Aren't there some banking and financial institutions that are starting to move to blockchain?
Yes, so 12 out of the world's 50 top banks are part of the Ripple credit network. And most all have some sort of initiative, and many also on private chains. So there's the R3 ECM initiative, and so a lot of the worldwide investment banks are all clearing together on that private chain. I saw a talk at a Chicago-based conference recently of a bank implementing a blockchain solution. So everybody, yeah, it is it's not just a strategic technology, it is the next wave of technology, so all banks will be implementing it. And it should be as unobtrusive as an ATM. When Chase Bank rolls out, a crypto wallet to me, then I can trust it.
Hi again. So you were mentioning the SWIFT network trying to basically on-ramp into blockchain. What do you think about the difference between Ripple and another token called Chainlink, which provides the middle layer? Basically, because banking industry is really in a laggard, they don't want to switch technology that quick, and that's why you see all these stock exchanges all still running Fortran programs. What do you think the difference between the Ripple and Chainlink and which, I guess, solution would the bank pick in regards to
I'm not familiar with Chainlink, but we would expect a number of different kinds of solutions popping up in the ecosystem. What I like about Ripple is that it's a nice 5-year, 27 million transaction proof of concept, and there's a lot of inspection and you can download its ledger and do all kinds of analysis. So it's very useful for us as a proof of concept, and many researchers have focused on the privacy issues that it brings up. And it's an interesting beast because it's an open network. Anybody can set up a node and anybody can be a market maker. So it's an open network, but yet it's mostly this very large bank, worldwide bank, interbank clearing function. And you can, it's not just a cash network, it's a credit network. So it's very interesting as a proof of concept, as something to examine. In terms of and I don't have a view, so they have, their consensus mechanism is based on validators. They have 55 validators that that confirm the transactions, and so that's another possible complaint that you're subject to. What these validate, you don't have a say in how validator software is updated. There are other issues with how the default parameters for credit links are set in the software. So I think Ripple is an interesting example with many of the robust details that we would want to be thinking about in these new kinds of open worldwide credit graphs, and that maybe the project you mentioned improves on that. Maybe other projects will improve on that, but it's absolutely an example of the new world of finance.
Does it still go through central bank? Like ACH clearing, they have to go through central bankers?
It goes through Ripple gateways. So it's a decentralized network.
We have time for one more question. I don't run that fast, so hurry up.
How many people are thinking about trying a Lightning payment channel? Oh, wow, great. For business purpose, or maybe with just friends for payment, see if it works and things like that? Both? The second one? Yeah, it's interesting. But then, because then also we don't want to think, we also want accounting and money to be unobtrusive enablers of our lives. We don't have to, don't want to focus more time on all of these detailed clearings with our friends or whatever. So it has to work for us.
Ma'am, the problem that I foresee with this is that money is money. Money's been around since probably before men. And the thing is, yeah, more than likely. And the thing is that the way that you move money around, it needs to go through the only way that humanity have developed that people cannot cheat with you. That's accounting.
Yep.
So somehow the blockchain, the payment channel, have to take that into consideration, because when you net it all, we are all broke.
Yeah.
Just like you said,
We
it's
don't
not
want
you,
it.
it's everybody. Everybody. When you net it out, there is no money around.
Yes, thank you. So the key point is the system has to be trustworthy.
Yes, of course.
Thank you.
Thank you very much, Melanie. I appreciate it. Thank you very much for being here in the morning.